Welcome to the B.F. Anderson Technical Report for December 24th. Happy Christmas, Merry Christmas, Happy New Year. Let's start off with a definition here. What is a secular bull market? Well, Morgan Stanley defines it. A secular bull market is one in which the long-term trend line is sloping upward and the current price of the S&P 500 is above the long-term trend. So let's just look at a graph here real quick. As you can see here, this starts out in 1980. Now, unfortunately, this chart doesn't go back to the 40s. But I can tell you that, the market basically went sideways from like 1966 all the way out to around 1983. So it was a real long 18-year period where no one made any money in the market. Well, then you launch a major uptrend. Now, you had the crash of 87 in here, but you can see here, this is the long-term trend line I'm using here. This is a 200-week moving average. So you can see that we came down to it here in the crash of 87. We tagged it a little bit here in 1990, but you can see that that line stayed true for a very extended period of time. I mean, an 18-year secular trend. So a secular trend is a long-term trend. Now, the question we have to deal with today is that what could possibly cause these long-term uptrends? Well, when you go through a 21-year bear market like we did starting around 2000, people get frustrated with the market. They put their money elsewhere. They buy bonds, they buy gold, they buy rent houses, they do anything but stocks. They're not going to do stocks because the human behavior out there remembers that we had this 49% drop in the dot-com bust, and they also remember that we had a 57% drop in the mortgage crisis. But the market will recover from this eventually as long as, earnings are good. So as you can see here, we broke out of the box and we have now launched what we believe, or our opinion is a long-term secular bull market. But it comes, generally speaking, after an extensive period of time where you're in a bear market. Like back here, we were in an extensive period of time of a bear market. Cash goes elsewhere. But then once it becomes apparent that we're in a long-term bull market, the cash comes back. The money has to go somewhere. So let's look at what's happening right now. Nasdaq looks very healthy, new high, uptrend, above the moving averages, very positive. This is really my favorite indicator. This is the 35-week moving average. It's just so steady. You can see here back during the virus, the COVID-19 problem, when it first became apparent, you can see here how we broke below it. However, we have been in a pretty solid uptrend ever since, so this is a very good indicator. Okay, now here's a new indicator that we're using called the New York High-Low, which is measuring highs versus lows on the exchanges. As you can see here, we're in very positive territory. This is where we have problems. Now, we have kind of rolled over a little bit, but the numbers have been so big that it was probably due for some type of pullback. Here are the number of new lows. Again, no problem. We stand below 40 a day, which is very constructive. Here we have the moving averages. One thing about moving averages, you can use any moving average you want that makes sense to you. But what I've done over the years is I've studied different moving averages that make sense. Now, on a long-term monthly chart, Luis Yamada, who's one of the top technical analysts in the world, simply says use the 10-month and the 20-month moving average and you look for golden crosses or death crosses. We are on a golden cross on the S&P. We're on a golden cross on the Nasdaq. We're on a golden cross in China. In fact, China's starting to pick up a little bit. Now, the aggression index, I got this from my good friend up in Boston, Mike Santolo, where we're measuring the Nasdaq composite compared to consumer staples. So we're comparing, technology to toilet paper and toothpaste. So when people are buying toilet paper and toothpaste stocks, they're negative and defensive. When they're buying technology, they're aggressive. So you can see here the aggression index is in solid shape. Now the actual indicator for the aggression index is the 40-week moving average. You want it to be in an uptrend, which it is, and you do want the ratio to be above that particular moving average. Looks very positive. Here we have the three economic indicators that we keep an eye on. This is interest rates continue flat. Oil maybe kind of losing a little bit of steam, but still looks okay. Financial stocks flat. So not a lot going on there. On the S&P 500, we're looking at the 25-day and the 50-day moving average. Looks positive. Here's the 200-day moving average. We're clearly holding this one. That's good. Here we have the put-call ratio. Now this is a kind of a problem area. This is the only indicator that I'm using right now that is telling me that there's something negative out there. Well, there's just too much greed. What happens is institutions and individuals, when they become optimistic and greedy, they buy call options. When they become fearful and scared, they buy put options. And you can see that the call option buying is way outweighing the put option buying. Therefore, a lot of greed. Sometimes sets us up for a correction, but you just don't know, but you should be aware of it. Volatility Index continues to look good. We're below 30 on the VIX, and it's very steady, so we're in good shape there. Now, before I get into the top 5, I wanted to mention this particular ETF. This is called the TAN, which is Investco Solar ETF. These are solar stocks. This stuff is really getting parabolic. It's the chart just caught my eye, and I wanted to share it with you. It really is amazing what's going on with these solar stocks. I think there's a lot going on in energy, alternative energy. Here's SunPower. Here's a solar manufacturer, all-time new high, breaking above 30. Got a buying volume cluster down here. Now, you know, in these top 5, what I'm also trying to accomplish here is not only show you stocks that are being very active, but also I want to kind of teach you a little bit about technical analysis. So in this, on individual stocks now, I like the 10-day moving average, and then I like the 50-day moving average. And I got this idea from William O'Neill, which is out in California, a very fine research organization. Basically, what you're trying to determine here is what is the normal pattern. And so it looks like to me the normal pattern is to follow the 10-day. And it's kind of gotten above it quite a bit, so you might want to let the moving average catch up to it or it pull back to the moving average, but looks pretty good. Here's Stitch Fix, which is an apparel company. You can see here parabolic up move. Now this is called a buy signal called a gap up, where you get volume that is way above, like the average volume is 3 million shares a day. That particular day when they announced earnings was over 22 million shares. So way above average volume. You know, your eye can see there is clearly a gap up. Looks good. Here's Grow Generation. Now, this is a stock that's involved in the marijuana industry. They sell equipment to grow marijuana hydroponically. You can see here, now the volume has been kind of quiet. It's been kind of quiet, but the stock has started to move back up again. Again, you can see where that 10-day moving average seems to be a normal zone for that particular stock. Here's a new one that we just are learning about called FuboTV. All I really know is it's somewhat of a channel where you can watch sports programming. I'll have to check into it some more, but look at this. Unbelievable. The volume, 35 million shares, normally trades 6 million shares. Gap up, way up there, kind of pulling back today. It's down 10% today, but just something to keep an eye on. Here's FreeportMcMoran, which is copper. Again, when we start to see the copper stocks doing well, it's telling you the economic activity is picking up, so it's always a good sign. So everyone have a Merry Christmas, enjoy the new year, and if you have any questions, please let me know. Thank you.